Everyone, welcome to another MakerDAO Collateral call. Today we have Nebula Capital Partners, which are going to be talking about their, the mechanism and how everything works regarding real-world finance. My name is Juan. I'm the facilitator of the Sustainable Ecosystem Scaling core unit, and I'm joined by, among others, Lea from Centrifuge, also Sebastian from Real World Finance core unit. Seb, is there something that you would like to say before I introduce the team, or?
No, that's fine. Continue your excellent job.
Maybe you wanted to give us an update about Real World Finance. But yeah, we're here with the team from Nebula. So Markus, Colin, and Tony. I'm probably forgetting half of them, so I'm sorry in advance. But you can introduce yourselves, and yeah, if you guys want to take it away.
Sure. I'll take over and share my screen, and I can also do a brief round of introduction on our side here. Can everybody see my screen now?
Yes.
Perfect. Yes. So also, once again, welcome from my side to this community call. Very excited to be here. Thanks for taking the time. And I suggest we dive right in. Pretty packed agenda here, and just as a heads up, so these slides are going to be made available online, and some of it is repetitive of what's in the application. So we're going to maybe skip one or two bullets here, but you can read up on it afterwards, of course. In terms of agenda, what we thought we cover here today, and I'll kick that off. So my name is Markus. I'm the founder of Nebula Capital Partners, which is NCP, or the sponsor in this transaction. And I provide the introduction here to start it off. I then hand over to Charlie and Johnny from TINKA, who is the asset originator, and Charlie is the CEO, and Johnny is in charge of many projects. And so we thought we summarize it here as special projects, and amongst others, it's going to be this decentralized finance opportunity. I've also seen Martin on this call here, and just for background, Martin is the chairman of TINKA. So welcome as well, and good to have you on as well here. After that, we're going to briefly cover process, timeline, and next steps. I'm going to do that, and Leah and Colin, I'm going to chip in here. And afterwards, we left some time for Q&A. Briefly to then Nebula Capital Partners. So the background is a business I founded earlier this year. It's a London-based investment advisory company. And really the focus is on bridging the gap between what I call FinTech lending opportunities, or FinTech lending originated credit assets, and the decentralized finance ecosystem. And why do I think this opportunity is attractive, or what really led me to establish this business is, on the one hand, this FinTech lending as an asset class. I consider, or I think it's very attractive from a risk-adjusted return perspective. And really, it is something that has only emerged recently, because there the ongoing disruption with FinTech and FinTech-enabled lending platforms, and Charlie's gonna elaborate on that further, really made these credit opportunities available for investment, which hadn't really existed before. At the same time, there isn't really the ability for institutional investors, and I would say Maker is certainly on its way towards being an institutional investor, to really invest in these assets efficiently and at scale. And why do I think specifically for the decentralized finance world these are attractive assets? It's twofold. One, there is a very granular asset base. So usually talk about pools of loans here, which provide a statistical investment approach. So very data-driven, sort of the granularity provides a diversification, which mitigates the risk in a certain extent. And that then in itself lends itself quite nicely towards the data and tech-enabled world of decentralized finance. Secondly, because of that granularity, and we're talking about thousands and thousands of loans here, depending on the portfolio size, of course, you're going to have daily repayments and redrawings. So there's an underlying cash flow velocity in these portfolios, which allow a certain liquidity in terms of redemptions and redrawings of these tokens. And the centrifuge technology, that's of course something that is provided for, and which I again think is quite an attractive feature here that allows these two worlds, the FinTech lending and the DeFi world, to come together. Lastly, where do I see the role of NCP or what we are doing here? We really want to be the interface between these two worlds. So we are an independent investment advisor. We're going to help structure the deal. We're going to help monitor the deal. And we're not going to do this as a pure advisor or in a pure advisor capacity, but we're actually going to invest into these transactions in a very much incentive aligned way. So we're going to have skin in the game, which again should provide the ability for Maker as the DeFi liquidity provider here to scale efficiently and frankly also use us as an outsourced provider and onboarding facilitator of these opportunities. Just very briefly, my background, it's also on the application, so I won't go into too much detail, but I come from a traditional finance background, spent the last 15 years with various institutions in the investment management industry, started off with Citigroup in the investment banking division there, then moved to Goldman Sachs, spent a couple of years in private equity and private credit, their merchant bank business. And then in 2013, I moved to KKR, which is international asset management business, and spent the last 8 years there helping build their credit business here in Europe. In my last role, I was responsible for the credit business in the DACH region, so Germany, Austria, and Switzerland. And that really included a whole host of activities, including sourcing, underwriting, and monitoring of transactions, and then also across a variety of credit products. So senior debt, junior debt, structured credit, but also special situations. Here is once again to illustrate what's NCP's value add in this transaction. And as I mentioned before, it's really this interface between FinTech-enabled lending platforms like TINKA and the various TINDEC pools we're looking to establish here in the month and years to come. And of course, not being exhaustive here, but the key activities which we're going to conduct is one, investment sourcing. We're going to do an investment due diligence and facilitate that process, both in terms of platform management, but also underlying data and track record. We're going to help structuring the transaction, which I think is especially relevant in the DeFi context and the regulatory aspects that we have to address. But then also, once the deal is done, we're going to help in the post-investment monitoring. So we're going to provide risk return analytics, and we're going to monitor and curate the platform interactions that are certainly required here between the community and the originator, like a TINKA. We're also going to help optimize the portfolio. So the idea here is really to have an evergreen or quasi-evergreen structure whereby proceeds either from additional debt capacity or from cash proceeds from repayments going to be reinvested. So we're going to make sure that these reinvestments happen in line with the eligibility criteria and hence the mandate that's going to be underlying the Maker transaction here. But also we're going to take care of hedging. In TINKA's example, it's going to be euro-denominated portfolio. So we're going to have really to bridge this euro to US dollar to DAI. And we're going to implement that program here, again, institutional approach and institutional quality. There's also going to be certainly some workouts we have to do, given the statistical nature here. We're going to have defaults in the portfolio that need to be dealt with. And that's something also that NCP will help and take care of. In terms of structure, nothing new here, but just again to illustrate the various components. So NCP will establish an SPV in a jurisdictions that allows for this issuance of these tokens in a regulated environment. NCP itself is regulated by the FCA, which is the UK equivalent to the SEC. So NCP will provide regulated investment advice to the SPV. NCP will then also, of course, interact with the asset originator, in this case, TINKA, and to make sure that this pool replenishment that's going to happen on a continuous basis happens in line with the mandate. There's going to be an incentive alignment. Of course, medium term, there is a reputation aspect where we want to make sure that we have an ongoing partnership approach, but also very much short term and financially driven. There's going to be alignment of incentives whereby NCP and the asset originator, in this case, TINKA, going to hold the TIN tokens here. So going to take any first losses or the residual risk of the underlying cash flows here. And lastly, which I think is important point to note, so this whole structure, the SPV, which will hold the loans, will be set up in a bankruptcy remote setup. And you have almost a double or triple protection here. One is in case something were to happen to the asset originator, NCP can step in or is already in the mix and help unwind or continue the portfolio depending on what the preference is. Vice versa, if NCP were to stop operating, certainly the asset originator could step in and of course is incentivized because there is a TIN holding. And lastly, both of these scenarios are supported by an external corporate service provider who will provide the SPV infrastructure. So the local director, the local accountants, and various other domiciliation service provided by this corporate service provider will of course continue even if there was an event that would impair NCP's or the asset originator's ability to take care of the transaction here. And really, to summarize, the idea of our approach is to really take a well-established institutional grade real-world structure and substitute what would ordinarily be a securitization note with the tokens and quote unquote substitute what ordinarily be an institutional real-world investor with the maker community and the maker protocol. And that of course then also includes working with really institutional grade asset originators who have scale, who have a track record. And I think this is the perfect time to hand it over to Charlie here, who is the CEO of TINKA, which I would certainly consider being one of them. Charlie,
nice. Thanks, Markus. Are you gonna, perfect. Just taking the opportunity to introduce TINKA, which I'm super excited about. So thanks all for your time. And I think the best to describe who we are is actually describing where we want to go to and what we have as our vision. If we're talking about our vision, we really want to be the most loved and most responsible deferred payments partner in the Netherlands and beyond. And that sounds maybe a little fluffy, but what that means in practice is most loved means we are going to have the highest market share and NPS across the consumer, the merchants, but also our own employees. And we use extremely easy language, no techno-lag, no special terms, B2 language, so everyone can really understand. And finances are notoriously complex by definition. And some companies try and hide things away in the terms and conditions or use words that are not easy to understand to confuse people. None of this. And most responsible for us really means in the end to have the market lowest number of arrears. So that means they have the lowest number of people, not euro values necessarily, but people that are going to get into payment problems. And one promise that we have is that we will never have any hidden fees. So you will not, if we're looking through our credit agreements or overall agreements, find in paragraph 280, subparagraph B, some hidden fees of 20 or 40 or 50 euros if you're not paying. It is it does not necessarily exclusively refer to Dutch, no, but it's primarily. And so that is our vision. If we're then going to our mission to bring that maybe a little bit more to life, what we are saying is we are innovating payment methods with a sense of, again, responsibility, complete dedication and care to achieve our responsible record sales. As you will also see later, when we get into our company numbers, we exist since 60 years. We are doing and in this business for more than 60 years. Here are our mission targets of where last year we started setting them on a 4-year roadmap. You can see the nature of the targets. The innovation is really around the product offering, where we are introducing our invoice proposition that we only have with one merchant now into the broader Dutch landscape to start off with. We are going to launch our debit card proposition. We are going to gain our transactional volume from 900 million that we have on an annual basis now to 1.5 billion this year. We are going to reduce our arrears from 4.7 in an annual cohort that we are sitting now to below 3%. We are on good track. We are leading, and our desire is to lead tactical regulations. That really means it starts off with the consumer. We are looking at what is good for the consumer. Then we are looking at what we are good at. And if we then find something that is good for the consumer that we are good at, and ideally our competition is bad, this is when we are talking to the regulator and say, there is something that needs to be done. And we have done that last year with the verification below 1,000 euros. So it's Dutch local regulation that you only have to verify what people tell you about the income and expenses when they're making a credit application above €1,000. And we did an analysis, identified that the most people with payment problems are actually coming from below €1,000, unsurprisingly, because there is no requirements to verify. We have talked to the regulator and really made a move that it gets pushed into market. That verification is from the first euro. That finance minister announced at the beginning of that year that it's going to come. And we are very proud of that, because that's not something easily done by a consumer credit company. This year, we're going to tackle the late payment fees. I want to cap them in the market. I think it's irresponsible how some of the buy now, pay later players act in this market by charging exorbitant fees. I've done a purchase myself a few months ago and not paid, just to see what happens. And I'm now a few weeks away from court, going to court with them. So they are taking me to court to sue me into private insolvency because I didn't pay. And the original €20 are now €80, with another few €100 coming on top of it. So that practice has to stop, because it is structural in this market. And well, we need to call it out. And as you can see, we are planning to go to other countries. We are really talking the Benelux countries originally with. Then we have something that we call our mission guardrails. We are saying we are going to fulfill our mission targets, but only within the guardrails that we are setting ourselves. And that is the NPS, as we said. That is the merchant as well as the customer NPS. The reason why it says stabilize here in this fiscal year, because we have just carved out of a larger group. There was a retail group, and we are now a complete self-standing business for the first time in our history. And we expected to have a halo effect from the retailer in NPS. NPS stands for Net Promoter Score. It's a measurement about how willing your consumers are to refer you to their friends and family. So typically what you see, especially in the consumer finance sector, is that you have a negative Net Promoter Score. That means that you have more people that are actually talking bad about you than they are willing to promote it. And so what we said is this year we're going to stabilize it. We're on a very good track, and then start growing again. For the same for the eNPS, that's basically the employee NPS, where we're asking our employees how happy they are working for us and how much they would recommend us as a good employer. As you can see, last year we've been negative, but the -7, believe it or not, is already an achievement. We came from -40. So it's we're at -7 now. We're going to continue promoting that. The well-being of our employees is equally important than the relationship with our consumers. And last but not least, we're talking about our risk culture, where we started last year to really define our whole framework, and for every measure across a variety of pillars, what our appetite is, that we started operationalizing this year. And in the end, I think that even if you're talking about something like risk, you can start loving it if you're approaching it the right way. So the way would be over the next years to really fully embrace the opportunities that lie within a proper risk management.
Can I maybe just, sorry,
yes,
really
Leah.
quickly, because there was a comment in the chat to specify NPS, just like while we're looking at the slide, that everybody has a good understanding of what it means.
I feel like Charlie mentioned that already in the narrative. So
yeah, I saw it. I saw the chat popping up. I tried to answer it. I'm monitoring the chat as well.
Okay, perfect. Cool.
Yeah, super good. If I'm missing something, please call it out at any point in time. Thanks, Leah. And if we're looking at our business, we are the market leader in revolving online point of sale credit in the Netherlands. We have a credit book around about 270 million at the moment, showing stable performance and payment behavior. We have, as mentioned before, 60 years of experience. We are under the regulation of the AFM. That's the Dutch regulator, the Autoriteit Financiële Markten. And we have an acceptance rate of 95% for existing customers on invoice, and 70% for consumers. We have less than 3% gross write-off, and we have real-time decisioning across the sector, typically within 2 seconds. So the whole credit application process, including all the verification that is happening in open banking standards, is happening within 2 seconds decision time. That is coming from the fact that we have been born out of a retailer. And as you all know, retailers have extremely high conversion pressure. And we have been innovating over the past decades to the point that we can make real-time quick decisions as part of the service proposition. If we're then talking about our potential and our strength, we do about 1.2 million credit requests per annum. We process 11 million payments, that is invoice payments and credit payments. We have a headroom of around about 100 million in our business, 2 million invoice customers on a regular basis, on an annual basis, 500,000 consumer credit customers, and then a customer satisfaction score. It's a different measurement to the NPS, but also consistently high at 8.8. If we are talking about our assets, clearly in the 60 years that we are operating this market, we have built an absolute treasure trove of Dutch consumer data, all obviously GDPR compliant, but however, we know a lot about payment behaviors, what early warning triggers are for people that might get into problems, for us to be able to help them to not get into problems. That is an amazing asset that we have built, where we are in an absolutely unique position to have over the years, over the decades, all of the data available. Then, as mentioned before, our headroom gives us an additional untapped potential for the merchant base that we're expanding in of around about 100 million. We have operated at scale point of sale, fully regulated in this business. As mentioned before, processing more than 1 million credit requests per annum with a very high and very responsible acceptance grading. And we have retail in our DNA. We are born out of a retailer. That's why we believe that with the carving out of the group, offering our services now to also other retailers, we are on an absolute path of really transforming this market towards more responsibility with our offering. If we are then talking about what our proposition to the merchants are, we help them clearly increase sales and their profitability. They are able to attract new customers that would like to spread the payments over a longer point in time. Typically, it increases basket size and it's creating an additional commission for those merchants. We are adding a unique set value add to the merchants. For the value proposition, typically consumer credit increases customer loyalty and brand loyalty. We see that the frequency of returning at merchants that offer our payment methods is about 175%. And it's overall strengthening the position in the market relatively effortlessly. The reason why is because responsibility is in our DNA. The danger for merchant is if you're partnering with the wrong credit provider, and there are not that many, but if you're partnering with the wrong one, how you treat the customers in the end will reflect on the merchant. And since we have our responsibility angle to treat people as people and not just as numbers, we will treat everyone with respect and the dignity they deserve. And that also positively reflects on the retailers. And I do believe and continue to believe that this is a unique position that we are able to offer. If we then go to next one, who are we talking about in terms of our consumers? We're looking at our consumers across 3 different main profiles. We're talking about the budget solver. It's typically representing 28% of our customer base. They borrow the money because they have a short-term budget problem. For example, a washing machine breaks down and they don't know how to finance that. And in the Netherlands, about 32% of the people can't afford an unexpected expenditure of 500 euros or more. That is a terrible statistic, and you can just imagine that if that would be exploited, that there would be a potential real societal problem. So those are about 28% of our customer base. However, we then also have the budget managers. They really just want to manage their budget. So they are preferring to have a positive balance on the bank account, and they don't mind paying the interest rates to maintain and keep the positive balance in the bank account, to spread it over time, to align it with the income levels. It's psychological safety. And then there are about 43% of our customer base are budget challengers that are saving for a specific purchase and just want to bridge the last bit to it to get it earlier. Sometimes because there's a special promotion or a deal that is happening that in the end saves them money. And if we're looking about the demographics, it's 58% female, 42% male. As you can see also from the income distribution, we 18,000 plus minus is the minimum salary in the Netherlands. So we are having a very low representation of people with minimum income in the Netherlands. And you can see that above the same representation we're having for people that are earning more than 100,000 on an annual basis. It's a healthy age mix, gender mix, and income mix that is represented as part of our consumer base. Over the years, you can see how we invested in NPS. You can see and customer satisfaction scoring. There is a trend upwards. We think we're stabilizing it this year, as mentioned before, as part of our targets, to then continue increasing afterwards again. But that lets it see over the years. If we're then talking about the cumulative defaults and recoveries, here you see the cumulative defaults over the years since financial year 2008, 2009. So that is the year that runs from April 2008 until end of March 2009. And to the last fiscal year that ended in April. And as you can see, over the years, we managed a reduction of 80% of our default rate. It's a continuous effort to really every single year reduce what percentage of the consumers, or in this case, euro values, is going into default. End of story. So it's what we managed to do is through increased acceptance processes and acceptance norms that we introduced, or the regulator introduced, we have massively being able to bring that back. And default, by the way, doesn't mean that someone is not paying at all. It means that they are overdue. And as you can see then, as the counterbalance with the cumulative recoveries, a variety and a lot of people start repaying again. And a portion of those repayments also just start repaying again, so they get out of default. And a portion of those recoveries is still coming from collection agencies. That's also something we are going to be moving away from over time. We want to insource the whole collection process, because I also do believe that it is important to own the process end to end. And no matter what contract you form with collection agencies, you will never be able to account for all the cases that the consumers are going to be treated as you want them to be treated. So this is why I'm a believer in actually insourcing that over time. And one of the things that we did probably means nothing to you unless you're speaking Dutch, but we also signed as the first one this Schuldeisene Manifest. And I was on a TV show there with a very reasonably aggressive TV host, Tim Hoffman, who chased us down because he wanted to speak us and challenge us on our past. And he also confronted me with this, asking me to sign it. And basically what it says is it's people are people and no products, right? That's basically what it says. And you wouldn't believe how many companies are refusing to sign this. It's ridiculous. And it just shows that this market needs change. It needs someone who comes in with the right vision, the right mindset, the right push, and shows everyone that it's possible to operate differently than what we have seen, I think, with some of the not so nice examples over the past decades. And in short, that's who we are, what we stand for, where we want to go, what our performance is, how our assets are performing, how we plan to grow.
That's great, Charlie. I mean, I just want to make one comment, just from an underlying collateral perspective. I think is helpful as people think through what a TINKA token or an NCP/TINKA token might look like. So as Charlie mentioned, the underlying credit itself carries a 10% interest. So if you just think through what happens with this credit or portfolio of credits over 1 year, it's effectively, if a credit of 100, it grows with a gross interest of 10 to 110. You then would have to look here at this default rate over 12 months. It's about 3%. So you would deduct from the 110.3, which would be 107, so 7% net return. But you actually have about, over 12 months period, about a 30% recovery. So you actually get 1% back on recovery. So the 100 gets to 108 after 1 year. Now, if we then think through what a potential drop token might look like, you're of course covered by the TIN token, and you're then covered by this net return that's being created every year. And then also, if you look at multiple year cohorts, you're going to have an accumulating buffer on top of the TIN, which is the accumulating interest, net interest. As you can see, it's fairly stable over the years, and there's of course a very, very long track record. A couple of words just on the transaction itself and the timeline here. Transaction as laid out in the forum, we would like to launch a pool of these unsecured consumer loans. They are actually contractually, there's a contractual claim on the underlying purchased item. Now you can argue how enforceable is that actually, but in theory it exists. And we're looking to launch an initial pool of about $10 million, which would be 8.2 million euros, which is the native currency here. In terms of line items, you're then talking about 25,000 individual credit assets. So the average loan here is about 300 euros. And the range is really from a couple of euros, what 5 euros is the smallest one, towards a couple of thousand euros. In terms of maturity, the loan agreements themselves are 72 months, so 6 years. But given we're going to take over, or TINKA is going to contribute an already existing portfolio, we're going to have one with an average of about 30 months. And just to put this in comparison, so the 8.2 million euros we're looking at here to transfer to the SPV, every year TINKA originates about 100 million euros of comparable point of sales financings. And that then also leads us to the next bullet here. Whilst we want to start with a $10 million US dollar debt ceiling, we actually would like to increase very quickly we want to ask for a 50 million debt ceiling, which we'll also look to achieve over the next 6 months, of course, subject to operationally everything goes smoothly and both parties are happy with the transaction within the smaller perimeter that we want to start off with. One important point, which Charlie didn't mention, but I think it's very important to point out, is that TINKA has a long established relationship with the incumbent banking environment. So they are banked by ING, which is the largest bank in the Netherlands, or frankly, the Benelux. And also TINKA has access to traditional public securitization framework. So really, this is an alternative to the existing, but certainly not a requirement for TINKA's perspective. But there's, as you could probably have heard from Charlie, there's just an inherent interest in pursuing this and diversifying TINKA's funding source here. But there are incumbent lenders which would be taking this exposure if for whatever reason we can't get to a transaction here.
Markus, if I may, also part of why I'm interested in actually going down this route is because I do think that I guess, as all of you, that this is the future. So this is the future of how this market is going to be financed. And I think what we might have together, also going back to our vision, is a chance to shape this market. We all know that regulation is going to come. We all know that there are bad faith players out there. And we have done our due diligence similar that you are doing it on us with you as well. We think you're a responsible party. We can clearly see it in the process that you're running. And we think there's a true chance to work on a massive competitive advantage, again, while doing the right thing for the consumers and the people who are then actually also investing in this. It's a prime example and a prime chance to form a good relationship with regulators, anticipate what is going to come in this market and create a unique value proposition for yourselves out of this, while at the same time doing the right thing for building the future of this market overall. Because before you know it, bad faith players are going to create a fog of mystery that the regulators are going to jump on. And before you know it, you're going to be drowning in regulations, left, right, middle, and center because of some bad faith players. And the regulatory capture in this market is, I also do believe, a very important one, because again, as you're looking forward, if you're onboarding assets that do not follow good regulations already, you might lose them at any point in time. It might reflect badly on you. So part of the interest is for us, this is the future, and we hope that we can live up to our vision with you to also responsibly shape this market.
I think it's a very good point, China. Also leads us to the timeline here. So I just laid out conceptually where we are today and what we've done to date and what a potential path forward could look like. So we launched the MIP6 application August the 2nd. Before that, we have been looking at this already for a couple of months. And frankly, what Charlie mentioned, one key aspect here of this particular transaction is the regulatory overlay. So we intend to implement this transaction in a European regulated environment. So you're not going to go via a Delaware LLC, but it now most likely looks we're going to go via a Jersey incorporated SPV here in Europe, so the crown dependency between UK and France here. And we are in contact with the regulator there, and we have already received sort of initial positive feedback that they're okay with us to go ahead with the securitization enabled by the centrifuge protocol. But of course, independent of that and the normal process here, as you know, we're going to start the green light poll officially process on the 16th, and then takes up to the 30th, hopefully with a positive outcome. During the time, we're of course going to continue answering any Q&A that come up. We're going to be continuing our discussion with the Jersey regulator, and we're going to start the preparation in terms of structure and legal documentation. Because as you can imagine, while it's the SPV via centrifuge to maker side is, of course, mostly in your hands and the smart contract driven, there's actually a side where we need to transfer the assets, these 25,000 loans from the Netherlands to Jersey, and make sure that the SPV can handle all of that, and not only one-off, but an ongoing basis. Then after hopefully positive green light poll feedback, we're going to engage with Seb and the team just for the due diligence and the onboarding process. Then of course finalize all the implementation requirements here. And lastly, just emphasizing the point once more, we're going to check also once everything is done with the regulator that there is an approval in place, because we want to make this squeaky clean here. We want to be able to point towards this is a fully approved and regulated structure, and the security token which we're going to issue falls under this regime, and the regulator approved it. And then I earmarked it here in square brackets, but I think from our side, we think we can in position to have this transaction implemented by end of September, beginning of October. I know there are, of course, a lot of applications already in the process, so I appreciate that we need to fine tune the timeline here. But then also afterwards, and it sort of leads me to the 2 points here you see on the bottom of the slide in terms of medium outlook. We want to upscale this transaction, and speaking on behalf of TINKA here, if we have a successful initial trial portfolio of 10 million, I think there's a clear desire to scale this up to 50 million pretty quickly, and potentially beyond if there's interest. Then also, as you heard Charlie talk about the various products they're introducing, but also the other products they currently have on their books, there could be a discussion to be had around diversification. So moving away or diversifying away from the point of sales financing product towards, for example, the invoice product, either as part of this pool or as a separate pool. But then also, to sum these 2 points up, really make a core component of TINKA's refinancing strategy. And that then really would put you in line with the INGs of this world, who are currently the incumbents here, who are also, of course, continue to be part of TINKA's strategy. From an NCP perspective, first and foremost, I want to facilitate and help make the TINKA transaction a success, and also, of course, showcase the value add that we can bring at NCP to make us a real-world asset strategy. Then subsequently, and on the back of a successful TINKA transaction, there are other potential pools that we're already in discussion with, and there could be either pure play pools or diversified originator pools, both of which I think make a lot of sense and would be quite a scalable way of onboarding more real-world assets here. And then lastly, and again, to summarize this, NCP wants clearly to become a trusted partner and a contributor to make us real-world asset strategy and ambition here. That concludes the slides we've prepared, and we now have sort of 15-20 minutes, hopefully, time for Q&A, and I would open it then if there's anything that you want to ask here.
It's great. Thank you, guys. I really like the presentation. Are there any questions for the team?
Yeah, how are you guys going to be handling the currency risk on your side, going from DAI to euro?
Yep. So that's of course nothing new in terms of euro to US dollar, and then US dollar to DAI is probably the easier part of it. So we're going to be working with an FX hedging advisor, and we're going to implement an institutional FX hedging program with swap and future contracts, just to take out the risk here and make sure that the underlying notional, especially from a drop perspective, is hedged on a US dollar perspective. So the US dollar tranche is not going to be impacted, or the SPV's assets not impacted by the swing of the US dollar versus euro. And we will include this in the final application. Once we sort of have everything together, that's going to be part of the due diligence effort we're going to go for with 17. It's going to be part of that.
So
I was
this is
wondering if you guys.
Oh, sorry.
Oh, sorry.
Go ahead, Juan.
Oh, please.
Good looking guys go first. Okay. So this is a very exciting space, and I want to thank you guys, both companies, for bringing this to the decentralized finance. It's obviously kind of a hot space too, right? For TINKA, there's a lot of competition, and also there's a lot of takeovers. So I kind of wanted to get, Carl, your thoughts on what the final goal is of TINKA. Is it to expand beyond the Netherlands, maybe come to the US and go up against a firm and the rest of them out here? Or are you looking to perhaps one day be bought out by somebody like Amazon? And I'm just speculating here.
So the plan would be to expand on a, first of all, in the next 2 years, Benelux basis. And then to the broader European market. We do not have plans to go outside of Europe. That said, if we are successful in Europe, there is no reason to not venture into other territories. But Europe is currently the end of our North Star. And then I think we are really talking about additional product diversification. So with our core products, capture the market in a responsible way. I think there is a lot to do also from a regulatory perspective. If you're talking about uniformity of regulations as a European Union, I think there are still massively different local interpretations of the consumer credit directives that are out there. I think if we're approaching it from a European perspective, there is work to be done that we would like to be part of. And then, as we said, responsibly demonstrate that this approach is actually successful, that we can get the growth numbers that we think we can, and basically prove the rest of the market wrong, that they have been acting and trying to extort every last cent of the consumers that they can at the cost of the consumer. And that is our vision, and that is what we are going to continue to do. But to answer your question specifically, in Europe, and yes, the pressure is high, right? So because we know there are some bad faith player in this market, we know it, we see it left, right, in the center. As I mentioned before, I'm going to go to court with one of them. So we know those players exist. We know it's going to be an uphill battle, but we also do know that with the scalability that we have built, with the tremendous unit economics that we're having, and with the processes that we have established to treat our consumers as people, it's going to be valued. I'm a firm believer in that, and that is going to give us the competitive edge on top of our unit economics and acceptance rates and everything else to compete against those players.
Can I add something, Charlie?
Yes, please, Johnny.
Just on the Dutch regulatory environment. So it's certainly one of the toughest consumer lending environments in Europe, in terms of the activity and enforcement of the regulator, but also in terms of mandatory law. So there is for example, the interest rate is capped at 10%. So which for an Anglo-Saxon like myself is something that's a little bit of a shock, but that's the system that we operate in. And I think we take the view that we sort of, if it's kind of like, if you can make it here, you can make it anywhere. We are proud of the fact that we come from a regulatory environment that puts consumers first. We think that from an expansion perspective, this kind of makes it, for us, it's a little bit like high altitude training, right? So we can drive a successful, profitable business on this basis in one of the toughest markets. It means that we should be able to expand organically into other countries on a case-by-case basis.
And just to build on that, and maybe to go back to one of the mission targets that we're having, if you remember the tactical regulations that we are trying to introduce, and specifically the part about the €1,000 verification, to explain in this context, what it does is 70% of our consumers come from below €1,000. So it's important for us to start acting there from a responsibility angle. But at the same time, we know that Klarna only offers credit up to €1,000. And there is a reason why they're only offering up to €1,000, because they cannot operationally take the burden of verifying above €1,000. Imagine us being able to successfully regulate that and getting it from 1,000 to 250. It kills that market for Klarna here. They are not able to compete. We killed yet another player. And this is what we mean. We do believe that by applying smart tactics and creating regulatory capture as a market entry barrier for others, because we are already operating in a fully regulated market, that we are hitting multiple flies with one flap, doing the responsible thing, getting everyone who is acting irresponsibly out, and in the end, enforcing everyone to also act responsibly while demonstrating to the broader market that it is indeed a sustainable business model.
One interesting aspect just on that is also worth mentioning. I know these days it's more the exception than the norm, but TINKA is actually profitable and cash generating, whereas a lot of the other buy now, pay later players are, of course, depending on various fundraising rounds to actually build their business here. But yeah, I think that's just underlines what Charlie said.
And then Markus, that is a super nice pole parsing, because basically, if you're looking at the revenue structures of our competition, again, going back to leading tactical regulation, what we said this year is we are going to start regulating late payment fees. Look at the revenue buildup of those loss-making competition that we're having. Look at the firms, the Afterpays, the Klarnas of this world. Between 10 and 40% of the revenues that they are making, in the end making a loss, but 10 to 40% are coming from late payment fees. We are going to erode those revenues again while doing the right thing, because what they are doing is they're marketing, saying, hey, we don't cost anything, whereas what in reality they are doing is they're making the people who can afford it least pay for everything, because the people who then pay the late payment fees are the people who can't afford to pay it in the first place. And we are going to try and stop those practices, which as a nice side effect is going to have that their revenues erode, and they are going to have it even harder in this market.
I have a question. You have a huge client base with, let's say they don't have too much funds. So they would be in a poor position if during an economic downturn. So how are you doing your own risk management with regards to economic upturns and downturns?
Good question. Thanks for that. So we do have a macroeconomic factor analysis that we are performing on a regular basis. As part of that, we analyze the correlation between unemployment rate and provisions that we need to be taking over the years. We have successfully, in our years of existence, managed any financial crisis. We have the data points for that correlation, and we are provisioned accordingly. So in all transparency, this year we have about 1.5 million provisions just for the increase additional for what we have seen in the COVID crisis. In the end, probably the foresight is better than it was in terms of unemployment rates of this crisis, because it looks like the Dutch economic outlook is companies are employing more than they are letting go, against what the forecast was a few months ago. But it's a regular, ongoing and audited, independently audited macroeconomic factor analysis that we are updating on a quarterly basis. This is how we are protecting against risk.
All right, so you're working with a revolving finance, or you have a buffer or?
Buffer.
A buffer.
We have a provision buffer that we have built over the years, and we continue building and writing on our books on an ongoing basis with every sale that we are doing.
All right, thank you.
The issue, very good point. I included in the deck, which can be shared online, also a slide just on this asset class in principle, and then of course the Dutch economic environment. Here on the left, you just see it's US based because US has the most transparent data in that regard. How credit card debt has performed over the last 30 years. And of course, if you think about point of sales financing, yes, the buy now, pay later players want to sell this as the major financial innovation, but of course, it is very similar to credit card debt. So a credit you take out by purchasing a product. And you can see here which is the underlying economics, which is the dark blue line, is the gross interest charge. So in the US, it's about, call it on average 12.5% to 15%. And then you see in light blue, the charge-off rate. So really the losses that have been booked on these portfolios. And I think from my perspective, the interesting part is that even after, say, a dot-com crash or the global financial crisis, the net returns on these portfolios did not turn negative. So even under the conditions of the worst financial crisis over the last, call it 70 years, you still had a positive performance on the credit card book. And then, of course, you would just think through a drop token in this context would then be protected on top by the equity buffer here. On the bottom left, you can see that this delinquency rate has the correlation with unemployment. There's a very logical and intuitive correlation here. And just on the right, we laid out actually what has the employment rate done in the Netherlands over the last 30 years. And most of the data, or naturally, most of the data that TINKA has is of course confidential and sort of sensitive. But I've seen it, and I can tell you that even through this period between 07, 08, and 21, which you can see included, probably the worst employment conditions in the last 30 years, the book did return a positive return in every single year. And that then speaks for Charlie's process in terms of the underlying risk scoring process, both on a micro level, so for the individual consumer, but also in the overall context, anticipating macro events and then, increasing or lowering the underwriting thresholds. So
is that, I see here on your screen, long-term use consumer credit. So that was for the US, but is that also applicable for the Netherlands?
Netherlands doesn't have the transparency in terms of data, but I think specifically for TINKA, we can tell you that this is also applicable for the credit that TINKA has originated.
Okay.
I got one that might be a little fun. So in our system, maker holders have to approve all the things we do, right? So from your perspective, what is the largest risk that maker holders should be aware of if we were to open up this credit line?
I can certainly start. Look, with the underlying asset itself, and again, there's one slide here, it is not a new asset class in itself. There is actually a very good and transparent capital market product you can point to, which is asset-backed securities. And I just laid it out here in a lot of numbers here, but in essence is you can see in the lower half of this chart here, you can see the slightly brownish line is credit card and credit card backed asset-backed security transactions. And you can see here spread is in terms of how do capital markets price these transactions. So if you take a portfolio of credit card debt and you say here the BB tranche has a 10% risk buffer, so that would translate into a drop token of 90%, the capital market would effectively price that with a blend of these spreads, which would roughly equate to, call it 2.5%. And that gives you a flavor of how the capital markets, over this asset class that existed in quite a long period, thinks about the underlying risk. So they, the implicit market tells you right now the risk on the underlying asset is quite limited. Now, I think specifically here, there is certainly an operational risk which we need to go through. So because, this would be the first securitization / tokenization at scale in Europe. So I think there's one to work through. And also just the velocity of the underlying portfolio here, because we're not talking about 10 loans we're going to be handling. We're going to talk about 25,000 loans to start off with. And then also every day, there's probably going to be 150 repayments, 150 redrawings of underlying loans. So I think the risk here is to a certain extent operationally, why we decided to go with a smaller portfolio initially to get a grab on, that all works flawlessly and well, and then scale up from there. But Charlie, maybe you have another perspective. I think that's sort of the key risk I see at this
Not
stage.
Another one, just a very good point, Markus, thanks. It's an additional one. It's one thing you can be relatively certain on is that it's going to shine a light on all of you and the chain in and by itself. It's going to gain quite some publicity. And basically, in case there should be any skeletons, I'd advise to get rid of them before that happens, because they are going to be flushed out. Not saying that there are any, we haven't found any, definitely, but it's just saying there is always, with publicity, there's always the plus and minuses that come with it. And you just need to be aware that there is going to be publicity around this.
Thank you. That was very informative.
And maybe just to add a point that maybe wasn't clear, well, it was clear, but just to emphasize it, is that the deal will be strictly, and every piece of the deal will be outside of the US.
That's
so
correct.
that will be the first one, and that will be the first geographical diversification in terms of legal structures, in terms of the underlying investment outside of the US. So it's also a good win for MakerDAO.
Correct, yes.
Yeah. I think we are out of time. I just want to offer it here as well. I mean, you got my contact details in the application. Please feel free to reach out. I loop in Charlie, Johnny, and Martin, who of course didn't speak here, but who is equally involved in all of this. And we are happy to schedule follow-up calls or answer anything in the forum there as questions come up.
Yeah, that's helpful. Thank you. Any last questions before we close the call? I think it's good you guys covered next steps. Just a quite clear timeline for anyone to find. Yeah, I agree with Benedict's super good presentation, really clear. So yeah, for anyone watching offline, we'll keep the discussions at forum.makerdao.com. I don't know if the team would like to say anything before we close the call.
No, very helpful. Thanks again for everybody's time. And as I said, don't be shy, reach out. Any questions, we are sure we can answer them, or at least we'll try our best.
Sounds good. Thank you, Markus, Charlie, and the rest of the team. It was nice having you.
Thank you.
Thank you.
Thanks, everyone.